Hello everyone, this is Victor here. Welcome to the Intelligent Investor channel, where you learn about stock investing analysis and personal finance that will help you become a great investor. There's the popular belief that retail investors cannot outperform the market, the S&P 500 consistently without picking stocks. This is completely false. Many schools and news media teach us that we cannot beat the market, the S&P 500 index in the long run unless we are as good as Warren Buffett. I can tell you all these are completely false too. In today's video, I am going to talk about 3 very easy strategies that beat the market, the S&P 500 index without much effort from you, without you picking stocks, without you timing the market, and without you spending hours analyzing the stock market. To show you how to beat the market without much efforts and without you picking stocks like Warren Buffett, I will cover these topics in this video. Why measure your portfolio against the S&P 500 index? First easy way to beat the S&P 500, the Nasdaq 100 index. Second easiest way to beat the S&P 500, sector-focused e-commerce ETFs. Third easiest way to beat the S&P 500, active managed innovation ETFs. Risks to consider and what you need to know. And what are the key takeaways? If you like this video, smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock investing analysis videos that will help you become a great investor. Let's start. First, why should you measure your portfolio performance against the S&P 500 index? If you have been investing for many years like me, you will know that the S&P 500 index is the best benchmark to measure your stock portfolio performance. The S&P 500 index is a market cap weighted index that's made up of the 500 largest public traded companies in the US. The S&P 500 index tells you how well the US stock market is doing and performing each year. If you want to know how well your stock portfolio is doing or how well your stock picking skills is, you will want to compare your portfolio with the S&P 500 index. If your portfolio consistently outperforms the S&P 500 index, that means you are a great investor and you have picked the right investments. And if your portfolio consistently underperforms the S&P 500 index, that means you might have picked the wrong investments, picked the wrong sectors, or timed the market wrong. There are many reasons. Here is an example. This is from Morningstar, the SPDR S&P 500 ETF. Tracking the S&P 500 index had a total return of 18.4% in 2020. If your portfolio return was higher than 18.4% in 2020, that means you did very well in 2020. The S&P 500's past 10-year trailing return was 13.88% each year. If your portfolio return was higher than the average 13.88% each year for the past 10 years, that means you did very well and you have consistently outperformed the S&P 500 index. So the higher your return is each year, the faster your portfolio will grow in value over time. Here is the important thing that is not taught in school. To beat the S&P 500 index consistently, you do not need to be like Warren Buffett. Warren Buffett spends 5 to 6 hours studying financial reports every day. Most people cannot do that. This article is from Yahoo Finance and ETF.com. If you look at the best performing ETFs in 2020, you can see most of them increased more than 100% in 2020 because these ETFs were either sector focused or they focused on innovation and tech industries. The first easiest way to beat the S&P 500 index is to find an ETF that tracks the Nasdaq 100 index. The Nasdaq 100 index is made up of the largest 100 non-financial companies listed on the Nasdaq based on the market cap. The Invesco QQQ ETF is the most popular ETF that tracks the Nasdaq 100 index. This is from the Invesco website. In the past 10 years, you can see the Invesco QQQ ETF that tracks the Nasdaq 100 index has consistently outperformed the S&P 500 index. For example, the QQQ ETF's return was 48.89% compared with the S&P 500's 18.4% in 2020. In the past 10 years, the QQQ ETF had a trailing return of 20.36% each year compared with the S&P 500's 13.88% during the same period. Past return does not guarantee future return. You have to do your own research and do your due diligence before investing in anything. We should understand why the Nasdaq 100 index, represented by the QQQ ETF here, consistently outperformed the S&P 500 in the past 10 years. Here are the main reasons. The S&P 500 index covers all the major industries and sectors, including the traditional industries such as financials, oil and gas, materials, and utilities. These traditional industries often underperform the technology and IT industry. This is from the Nasdaq website. If you look at this industry breakdown here, as of second quarter 2020, you can see the S&P 500 index had 23% in the tech industry, while the Nasdaq 100 index had 57%. The S&P 500 had 18% in financials, 4% in oil and gas, and 2% in basic materials, while the Nasdaq 100 index had none in these industries. Here's the very important part. The Nasdaq 100 index outperforms the S&P 500 index mainly because it has a much larger exposure in the largest IT companies with zero exposure in financials compared with the S&P 500. If you look at the Invesco QQQ ETF here that tracks the Nasdaq 100 index, you can see all the tech companies, Apple, Microsoft, Amazon, Tesla, Facebook, have the largest weight. Right now, we're living in the information technology age that is driven by constant innovations from companies. Only companies that are most innovative can survive over the long run. All the largest companies in the world by market cap are mostly tech companies. Just look at Tesla, Amazon, Apple, Microsoft, Google, and Facebook. Because tech companies as a whole industry have a much higher growth rate than the traditional industries, I believe the Nasdaq 100 index will continue to outperform the S&P 500 index in the long run. The second easiest way to beat the S&P 500 index is to find a sector-focused ETF that focuses on e-commerce and internet companies. For example, the All-Shares Global Internet Giants ETF increased 107.58% compared with the S&P 500 index, 18.4% in 2020. According to this fact sheet here, the All-Shares Global Internet Giants ETF focuses on some of the largest global companies that derive most of their revenue from the internet technology and e-commerce business segments that exhibit above average growth potential. If you look at the top 10 holdings here, you can see the ETF's largest holdings include Amazon, Alibaba, Alphabet, Tencent Holdings, Facebook, Microsoft, Pinduoduo, and Shopify. The pandemic that started in 2020 has accelerated online shopping to at least several years ahead of schedule. Customers are buying things online much more than before. For example, according to eMarketer, US retail e-commerce sales increased 32.4% in 2020. Going forward, eMarketer estimated that e-commerce sales worldwide as a percentage of total retail sales will continue to grow. Even after the pandemic is over, more and more consumers will continue to shop online using e-commerce services such as Amazon and Shopify. Because of this online shopping trend, I believe the ETFs that focus on e-commerce and internet companies will continue to outperform the S&P 500 index in the long run. Another reason is that e-commerce companies such as Amazon and Shopify have much higher growth rates than most brick-and-mortar retail businesses. The third easiest way to beat the S&P 500 index is to find active managed ETFs that focus on innovation and disruptive companies. For example, the best active managed ETFs that focus on disruptive companies are ARK ETFs managed by Cathie Wood. I believe Cathie Wood is the best investor right now because Cathie Wood and her team focus on finding the best disruptive companies even before many other fund managers. For example, in 2018, Cathie Wood made a very bold prediction about Tesla. She predicted that Tesla would hit $4,000 per share pre-split in 5 years. Many analysts doubted her. Now, Tesla already reached above $4,000 per share pre-split and $800 per share after split, 2 years ahead of schedule. In 2020, Cathie Wood's ARK Genomic Revolution ETF was the best performing fund with a 180.55% return. Her other flagship fund, ARK Innovation ETF, had a return of 152.83% compared with the S&P 500's 18.4% in 2020. It's important to understand that not many fund managers can outperform the market consistently. Personally, I like Cathie Wood's investment strategy to find the best and most innovative and disruptive companies to achieve above average long-term growth. Before making this video, I invested in ARK Innovation ETF, ARK Next Generation ETF, and ARK Genomic Revolution ETF for one of my portfolios and my mom's portfolio. I am planning to invest more in ARK ETFs going forward. Now let's talk about the risks. The first risk is that past returns do not guarantee future returns. You will need to do your own research, do your own due diligence, and consult a financial advisor if you need professional advice. ETFs are great for investors who don't have the time and expertise to manage their investments. But you still need to do your own research and understand the potential risks and returns before investing in anything. One thing that helps me a lot is to only invest the money I don't need. The second risk is this: when there is a market correction, such as the dot-com bubble in 2000, the ETFs that track the Nasdaq 100 index or the sector-focused ETFs that focus on e-commerce and tech companies may underperform the S&P 500. The S&P 500 is more diversified in different industries compared with the sector-focused ETFs. The third risk is this: the sector-focused ETFs that focus a lot more on tech stocks are more volatile than the stocks in the traditional industries, such as banking, oil and gas, and utilities. Tech stocks tend to be traded at a premium because they often have higher growth rates. Tech stocks also tend to have higher price to earnings and price to sales ratios compared with stocks in the traditional industries. It's important to understand that sector-focused ETFs that focus on the IT industry can be more volatile than the S&P 500 index. So what are the key takeaways? I believe there are 3 very easy ways to beat the market, the S&P 500 index, in the long run without much effort. The first one is finding an ETF that tracks the Nasdaq 100 index. The Invesco QQQ ETF is the most popular ETF that tracks the Nasdaq 100 index. The Nasdaq 100 index tracks the largest 100 companies in the Nasdaq, excluding financial companies. The Nasdaq 100 index has historically outperformed the S&P 500 index by a large margin because the Nasdaq 100 index has a much larger weight on the IT industry than the S&P 500 index. The second one is finding a sector-focused ETF that focuses on e-commerce and internet companies. One example is the iShares Global Internet Giants ETF that focuses on the largest global companies that earn the most revenues from e-commerce and internet technologies. Even after the pandemic is over, I believe e-commerce businesses will continue to grow because more customers are shifting their purchases online. The third one is to find ETFs that focus on the most innovative and disruptive companies. The best innovation-focused ETFs are the ARK ETFs managed by Cathie Wood. In my opinion, I believe she's the best investor right now. To summarize, I believe ETFs that track the Nasdaq 100 index and ETFs that focus on information technology tend to beat the market, the S&P 500, in the long run because tech and IT companies as a whole industry tend to have much higher growth rates than the traditional industries. If you like this video, make sure to smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock investing analysis videos that will help you become a great investor. Thank you for watching. This is Victor from the Intelligent Investor channel. I will see you in my next video.